Last Friday, on March 10th, Silicon Valley Bank failed. It was the 16th largest bank in our country and caught many people by surprise. How could a bank of that size fail so quickly? Just a month ago, its share price was trading at over $300 per share. So what happened in such a short amount of time that caused Silicon Valley Bank to fail? Well, to understand their story and its failure, we have to go back to 2020 with COVID and the lockdowns. At that point in time, the federal government started spending enormous amounts of money, and the Federal Reserve took interest rates to basically zero and started pushing enormous amounts of money into the economy, into the capital markets, through something called quantitative easing. In fact, they injected over $4 trillion of money into the economy. As a result of that, the stock market started to boom and soon turned into a bubble, particularly in tech stocks. Well, all these tech companies and VC funds, venture capital funds, started raising enormous amounts of money. And as a result, Silicon Valley Bank, being the biggest bank to the tech industry, started to see a flood of deposits into its coffers. So as the economy continued to improve and the federal government unfortunately continued to spend more and more money, inflation took hold. And once inflation took hold, then the Federal Reserve had to change course and started to raise interest rates and drain liquidity out of the system through quantitative tightening. Well, this comes to the core reason of Silicon Valley Bank's failure. The executive team of that bank made one of the cardinal sins of banking, and that is lending or investing long and borrowing short. What does that mean? Well, a bank brings in depositors' money or borrows from entities like the Federal Home Loan Bank Board or the Federal Reserve or the capital markets. Banks then take that money and either lend it out in loans or invest it in securities and bonds. And then they make a spread off the difference between the yield on their assets and the yield on their liabilities. Well, because the Federal Reserve had to change course and raise rates, all those bonds that Silicon Valley bought were largely mortgage-backed securities at a very low interest rate. So as the Federal Reserve started to raise interest rates, their whole bond portfolio started to go underwater on a mark-to-market basis. What does that mean? That's just basically essentially revaluing a bond based upon current interest rate environment. So as a result, they started taking significant hits to their net interest margin because their funding costs were rising and the yields on their assets were at the same point when rates were very low on all those mortgage-backed securities. The other problem is their depositors were VC funds and tech companies. Well, most of those tech companies are cash flow negative. They're all focused on growth, unlike most normal businesses that are focused on positive cash flow and earnings. So as these tech companies were no longer getting funding, they started to burn through the cash on their balance sheet, and that started to come out of the deposits of Silicon Valley, which only exacerbated their funding costs going up. So they got into a squeeze. Silicon Valley had to go out last week and announce that they were selling a group of securities and taking a sizable loss of well over $1 billion, and were trying to go out and raise new equity capital. That caused the other big problem, which is an old-fashioned bank run on the bank. And in our modern world with modern technology and social media, the big VC funds started telling all their portfolio companies and tech companies to get their money out of Silicon Valley Bank. So over $40 billion started to exit that bank at the end of last week. Well, they couldn't handle that because all their securities that they were going to continue to have to sell would have just created more and more losses. So on a mark-to-market basis, Silicon Valley had no capital. As a result, the federal regulators had to step in and take over the institution on Friday. So that's the reason Silicon Valley Bank failed. It's very unfortunate. Part of it was they're a victim of their own success, but more so, very poor decisions on their investment portfolio and how they're funding by all these tech and VC funds that all ran the second they heard any kind of trouble. Now, fortunately at Sunwest, we're a very different bank. I always talk about how Sunwest carries a fortress balance sheet. Why? Because we're built for difficult times. We carry more capital than the rest of the industry, about 50% more. Our reserves are at the highest in the industry. We carry ample amounts of liquidity that we invest short term, and our underwriting is very disciplined. As a result, during the last great financial recession, when Lehman Brothers and Bear Stearns failed and many banks were on the rocks or failed, we were approved by our federal regulators to buy 5 failed banks during that time frame. So we will always be a beacon of strength during difficult times because it's important for us to take care of our customers, to make sure your deposits are safe, and to be able to continue to lend to you in difficult times. Further, we want to create a safe and secure environment for our employees. So Sunwest will always be the bank with the fortress balance sheet, and we'll weather through these storms ahead. And thank you for your time. Have a wonderful day.